Let's talk about OnlyFans taxes. There is a common misconception that this industry is different to any other and that suddenly tax law doesn't apply. Whereas in fact, we all have an obligation to pay tax. Some of us do. The vast majority of agencies and creators don't. Now, whether you're a bedroom OnlyFans agency like most people, or whether you're a corporate office agency like ourselves, it doesn't change the fact that we all have an obligation to abide by tax law and pay our fair share of tax. I can't fathom the number of people that think it is genuinely acceptable to just leave it to the accountant. Because frankly, in this space, I'm yet to meet an accountant that truly understands it. The majority of accountants will have you paying double VAT and frankly just don't understand what are expenses and what aren't. So today we're going to walk through how OnlyFans taxes work and how you can be more efficient. First off, some basics. You have an obligation to pay tax. This is the exact same as any other income, and therefore you have to abide by the tax law in your jurisdiction. Let's use the UK for example. Here in the UK, you can take advantage of £1,000 where you don't even have to complete a tax return. Beyond that, as a self-employed individual or an individual making a side hustle, anything over £1,000, you have to submit a tax return, even if you aren't paying tax. If you earn in excess of £12,570, you have an obligation to pay tax on everything over that threshold. Between £12,571 and £50,000, you're paying 20% tax. But anything above that, and you're jumping straight to 40% tax. And it is at this point that we would then consider, do we want to pay 40 or 45% tax? Probably not. And we may want to address the idea of setting up what we call a limited company. When self-employed, you pay tax on your income. When you have a limited company, we have these wonderful things called business expenses that we can deduct before we have a profit figure, and that is what we pay tax on. Examples of business expenses for creators are things like transport, laptop, phone, content, props, etc. And typically for agencies, these are going to be things like marketing, staff cost, admin cost, account cost, etc. As the director of your own company, this gives you the opportunity to take what are called dividends. Now, this is a share of the profits that are split amongst shareholders. You are the only shareholder, likely, and therefore the only one who takes this profit share. The best part about dividends are that they start as simple as free for £2,000 and 8.75% for the first chunk that you take. If you're a creator or agency that are making under 100,000, this is going to be a great way to reduce the amount of tax that you pay and a much more efficient way of managing your accounting. For a simple observation of what the best thing to do in your position is, if you're making enough to pay 20% income tax, pay it. If you're making so much that you need to go on and pay 45% tax, it is at this point you need to consider the value in owning your own company and taking dividends. Regardless, if you're a creator or an agency, and you're an individual or a company, if you are making over £85,000 turnover here in the UK, you are obliged to pay what we call VAT, value added tax. Now, the difficulty with value added tax is that in most industries, you have an obligation to pay this no matter what. However, with OnlyFans, as a creator, you actually don't really need to pay it at all. This is because when OnlyFans charges a customer $10 for a picture or a video, they're actually going to charge them $12. Now, you only receive 8 as the creator, OnlyFans take 2, and HMRC take 2. You don't even notice this happening because you only receive $10. The customer actually paid 12, and as a result, that $2, that 20% that constitutes VAT, travels directly to HMRC via OnlyFans. And as a result, you are already collecting and paying VAT, and you do not need to pay VAT yourself. Most creators don't know this, and most accountants don't know this, and as a result, creators are paying VAT twice, and you are expending 20% extra that you didn't need to spend. As an agency, it's not quite that simple. We have an obligation to pay VAT, so if you're earning over 85,000, or whatever the bracket and tax scenario is in your jurisdiction, you have an obligation. So, when do we actually have to pay tax? Typically, on an annual basis. Every jurisdiction is different, but in many cases we pay tax annually. The beautiful part about annual tax returns, whether you're an individual or a company, is that you often get what we call a buffer period, whereby at the end of the year you are given an extended time frame to pay the tax for that given year. So practically, if you were coming up to your year end in December, meaning that you ran from January 1st through December 31st as your year, you wouldn't necessarily need to pay that tax until into something along the lines of September, because that's the buffer period that they give you to pay the tax. So now we know when to pay tax. Well, why do we even have to pay it? Why can't we all just make as much money as we can and keep it all? Well, you probably could. We're not financial advisors. We don't care. But equally, we're not here to teach you how to run a bedroom business. We're here to teach you how to be a professional and set up an agency with a corporate standard that's going to run sustainably. You've probably heard about every Tom, Dick and Harry telling you how to save paying tax, how to stop paying this, how to avoid paying that. And that's fine, because in a lot of scenarios it makes sense to do that. But it isn't actually always a bad idea. So sometimes just pay what you owe. Not only are you going to have very little pressure from authorities and absolute peace of mind, but you're also going to be able to take advantage of better access to finance, better access to borrowing. If you show a better return, you can probably go on and take advantage of mortgages, possible car finances, possible loans, things that may actually benefit you in the long run, or even something as simple as offering you a better APR on your monthly payments. Especially when relating this back to being a top drawer man and chasing excellence in every department of your life, if paying a little bit more tax allows you to have your own house, your own car, that's a massive net win for you as an individual. But also, it doesn't sound particularly appealing to me to have HMRC or the IRS or any tax authority on your case chasing you for tax. It just gets in your way of the ability to focus on making more money, which probably makes more than paying tax anyway. So, what to do next? What are the take-homes? What should you do now you've watched this video? Well, firstly, you need to know what's going on. If you don't know what's going on, it's your own fault, and you're going to run into problems, and it's your fault for doing that. If you track the money that you make, the money that you spend, and you have a proper infrastructure behind you, it's going to be a breeze. I'm going to actually post in our Telegram group now, that's linked in the description, a template for income and expenses on a spreadsheet basis. You can download and use this for your own accounting purposes. This is completely free. I'll also send the link to a tax calculator and personally walk you through the process step by step. Then you need to understand how VAT works. Does it apply in your country? How does it work? And how does it affect your business? And finally, just store enough money to pay some tax. Keep back 10, 20, 30, 40%, whatever you feel is a fair justification based on your jurisdiction, and have the money available for when that day comes when you owe the government some tax. So before you go and pour a bottle of champagne on your Rolex in the club or buy yourself a rented Lambo in Dubai, just make sure you've got enough in your tax pot.